Good afternoon, everybody. Thank you for joining part 2 of our webinar series on the life cycle of an M&A transaction. My name is Ntebaleng Sekabate, and today I'll be joined by Christoph van Rensburg and Mangaliso Nzimande. And we will be discussing the pitfalls that you need to look out for when implementing your transaction. And Mangaliso will kick us off with talking about what to look for as a result of the due diligence.
I would like to start with pitfalls relating to due diligences and specifically warranties and what we see in the market now more often being used in M&A transactions, which is the warranties and indemnities insurance. So as we all know, warranties and indemnities are part and parcel of almost every M&A deal. And basically it allocates the risk of unforeseen liabilities between the buyer and seller. And typically the buyer will then have a right to claim for unforeseen pre-completion liabilities that arise. But so that is what basically warranties and indemnities are for. And I think one thing to mention that is important regarding warranties and indemnities is that most often what we see in transactions is that the transaction will be negotiated, the agreement will be drafted with all the nice warranties and indemnities, but those warranties and indemnities are then no longer shared with the bigger tax team. So because it's important for claim purposes for everyone to be aware of the requirements, the notification requirements, and the claim requirements relating to those warranties and indemnities in case a liability does arise in the future. So it's important for everyone to be aware of those indemnities and warranties. And so that if the claim does arise, they can notify within the time limits that are set out in the agreement. What I want to talk about a bit more in details is warranties and indemnities insurance, because we are seeing this being utilized more often in the market. And the purpose of warranties and insurances in insurance is basically to cover unforeseen liabilities. And this is where a proper due diligence exercise becomes critical, because a proper due diligence exercise is pivotal to warranties and indemnities insurance, because the insurers rely on the due diligence reports in order to assess the risk and to price the risk. And if the risk is not properly assessed, then it might impact on the pricing of the risk, and it might also impact on the availability of the insurance itself. So it's really important to make sure that when you're doing the due diligence exercise, that it's detailed and it covers all the material aspects. Now, what we often see when we conduct due diligence exercise, or when we are requested to quote for scope and pricing, the client will ask us, can you please quote for a standard red flag due diligence exercise? And then, but what we then see is that we will then conduct the red flag due diligence exercise. But what then happens is when the client tries to obtain warranties and indemnities insurance, the insurer themselves will then assess the reports that has been done, and then they will come back and say, actually, can a more detailed exercise be done, a more line-by-line item exercise be done? So what we recommend now is that if we're going to do a due diligence, that a full scope due diligence be done, because it might transpire that later, if we go for a red flag, that you might come back to a full scope due diligence exercise because of the requirements of the insurer, because it's pivotal to how they assess the risk. Now, I think it's also important just to mention that there are various reasons why warranties and indemnity insurance has become so prevalent, and I think the main reasons are risk allocation between the parties, where for some reason the parties cannot agree to risk allocation. They can then bring in the insurers to bridge that gap between the parties, and also where for some reason the buyer is unable where the buyer is offering limited warranties or a limited cap on the liability caps. the insurance can then be brought in, warranties and indemnities insurance can also be brought in to then also cover that aspect as well. And what we're often seeing with private equity funds, where private equity funds are the sellers, they often prefer a clean exit. So they will then insist that insurance cover be in place, and the insurance cover can either be taken by the buyer. In that case, then the premium will reduce the purchase price, or it can be taken out by the seller themselves so that they can achieve that clean exit because the liability is now assumed by the insurers. So that is now something that we're seeing being in the market, being more prevalent with M&A transaction, and it actually assists in M&A transactions. So what I also want to talk about, which my colleague Gustav spoke about in part one of this presentation a few weeks ago, is tax liability insurance. And what we are seeing is that tax liability insurance is really starting to play a crucial role in M&A deals. Previously, where risk items that have been identified, which could have been real deal breakers, can now be mitigated or managed by way of introducing tax liability insurance. I'll give an example which my colleagues also touched on in the previous presentation, where we had a deal, and the deal was in a context of a competitive bidding process or a tender process. So, and there wasn't much room for our clients to negotiate for other alternatives like escrow funds or restructuring the deal. So we were really limited there, and we went in, we did the due diligence exercise. We came across a number of risks, but there was one which could have been a potential deal breaker for us or for our client. And then when that risk was identified, it was communicated to the buyers, and the buyers were quite adamant that it wasn't a risk. They went and got their own advice, which agreed with their position that it's not a risk. And as far as they were concerned, the buyers, that was the end of the matter. So the client had to then decide, because it's a bidding process, whether they want to proceed or do they then look at other factors. And what we recommended is that, well, if they want to proceed with the transaction, because it was very likely that they were going to be appointed as the preferred bidders. So the only issue was just this test risk that had been identified. So what we advise is that, well, since the sellers are not willing to even consider this issue, if the client wants to proceed with the deal, they should then take out tax liability in insurance in respect of the risk that had been identified. Now, it's also important to mention that it will not be all cases where the tax liability insurance will be put in place, because as you will understand, underwriters have different appetite for risk. And in this particular instance, which I thought was quite good for us, because we had picked up the risk and we had raised the risk, was that when we then brought in an insurance broker to have a look at the risk, and then we asked the insurance broker to go into the market to see how many of the underwriters were willing to underwrite or to cover the deal. And it was quite interesting, because 8 responded, and out of the 8, 3 came back and said, well, it wasn't within their risk appetite. The other 4 came back and they engaged with us for a while, but ultimately 1 was willing to take on the risk. So it's not all risk that can be covered under tax insurance liabilities, but it is quite useful. It is very useful in order to make sure that the deals go ahead and to make sure that the risk is managed for both parties. And Tabeleng, if I can just ask you to just take us through your comments on the escrow arrangements.
Thanks, Marlisa. So when we deal with escrow arrangements, and it's quite interesting, because most times with the escrow arrangements, it's quite large amounts that will be placed in escrow for the parties. And then when it comes time to start reporting on the tax for either the buyer or the seller, then we have questions such as, the deductibility of the expenditure for the buyer, or the inclusion in income for the seller. And then you have issues of, what are the base costs for the buyer of the assets that have actually been bought, etc., etc. And of course, you do sort of need to match, the buyer and the seller need to match their tax treatment, because obviously, if, for instance, the buyer takes a deduction on the amounts that they've paid into the escrow and the seller does not include it in their income, suddenly the fiscus is now prejudiced, right? And what we find is nobody actually, or some people don't actually think about the contractual terms of the escrow agreement, because that will actually determine your tax treatment of the amounts. So, for instance, if the amount must sit there, and in certain instances it can revert to the buyer or it must be paid over to the seller, then the parties must sort of keep track of what's happening contractually with that money and when is the appropriate time to either include it in income or take a deduction. And then we also have to keep 24M in mind here, section 24M, which deals with unquantifiable amounts and the accrual and incurral of those amounts. So it does say if there's an unquantified amount, it won't accrue, or it won't be deemed to accrue to the seller, and it won't be deemed to be incurred by the buyer until it becomes quantifiable. So you have to keep track over the term of that escrow arrangement when the buyer becomes liable to actually make the payment, so when they incur it, and when the seller becomes entitled to that amount. And I think that sometimes becomes a bit lost, and then the parties come sort of 2 years later after the money's been sitting in escrow, and there's already been some kind of entitlement, and that amount hasn't been either deducted or included in income. And also, it also adds another complexity for when you have allowable depreciable assets and you have to claim allowances, because usually what clients will do is they'll have their tax asset register. They'll decide, okay, the allowance that I can claim in respect of this is 5% a year, let's say. And then suddenly in the next year of assessment, these amounts either accrue or are incurred for purposes of 24M. And you actually are entitled to claim the allowance that you would have been entitled to in the previous year in that subsequent year. So in year 2, you would then say, well, I was entitled to claim 5% in last year, and now this year I'm also entitled to claim 5%, so then I'll claim 10%. So you can't sort of just put it in the system, whatever system that you're using, and then just think the system will kind of run through and just claim 5% and smooth it out. You do have to keep 24M in mind when you have these escrow arrangements in place, and sometimes this falls through the crack as well.
Well, I think an important point that I want to make is that it's really crucial for a proper due diligence exercise to be done, because all potential additional tax assessments or tax liabilities should be raised in that due diligence report. And then once they have been raised, the parties can then negotiate and decide how that risk can be managed. And I think that's critical for both the parties and their advisors to have a real problem-solving focus and collaboration with each other, so that they can then consider which of these mechanisms, whether it's insurance arrangements, whether it's escrow arrangements, alternative restructuring, can be employed. Now, sometimes, as I mentioned earlier on, alternative structuring is not an option, particularly in competitive bids, because what happens is that the sellers will prepare a vendor due diligence, which will then come with a structuring in terms of how they want the deal to be done, and then it's a take it or leave it. So you then decide whether you want to proceed with that deal, you want to proceed with the bid or not, and that then really limits the availability of the other alternative that you can use in order to manage the risk. But I think what is important is that there has to be real focus on problem solving between the two parties and their advisors in order to make sure that the deal does go through, but that there are also enough protections for both parties. And then if I can just quickly touch on, I'm just wary of time, quickly touch on the disclosures in the due diligence reports and the risks of inadequate DD. And the main risk, as I've mentioned, is that if you are going to take out insurance, especially warranties and indemnities insurance, the insurers rely on that due diligence reports. And if it turns out later on that, well, there was something that should have been picked up but wasn't picked up in the process of doing the DD, then the insurers can repudiate the claim. So it's really, really important that a proper due diligence report be done as well. And then also there's also the question of how much do you disclose in the report itself? Because on the one hand, you have the insurers wanting to make sure that the report is as detailed as possible because they're relying on it. And then you also have the requirements, especially where you have offshore investors as well, because of their reporting regimes, they might want the reports to be as detailed as possible as well. And then that, of course, then raises the question as well, what if then SARS comes across this document? Is the document subject to legal privilege? Of course, if the DD was done by someone who's not an attorney, say, for example, an audit firm, that question doesn't even arise. If SARS requests that DD reports, they have no option but to provide it. But if it is done by a firm of attorneys, it does provide a level of protection from a legal privilege perspective. It's not 100% guaranteed because it depends on the facts of each case, but it also doing it with an attorney does provide that level of protection. Now, in practice, I haven't really seen, I don't know whether Crystal and Tabeleng, please come in. I haven't seen SARS doing an audit and then requesting a due diligence report in order to assess whether there is risk in that transaction. To me, it sounds like a low-hanging fruit for them, but I haven't really seen them utilize that in practice.
No, Mangaliso, I haven't either. But what we have seen in recent times is SARS requesting tax opinions. And when the taxpayer says, no, they're legally privileged, then SARS says, we are not giving them relevant material for their audit. And somehow we are now infringing or, inhibiting their ability to properly audit. And I mean, there was no argument that these tax opinions were legally privileged, but SARS did insist on receiving them, and we had to push back. So, I mean, in light of that, that was the first time I'd seen that. So, as you say, it is low-hanging fruit. And maybe if somebody gets the idea in their head, this is not an outlandish thing to ask for.
I hope we don't have SARS on the...
No, we made sure.
We don't want to give them ideas. No. So I think from my perspective, I think just to stress that doing a proper due diligence review is really critical for both parties, and also just to protect the target going forward as well, to make sure that all risks and all unforeseen risks are covered, and risks that are known are either covered by tax liability insurance or by some of the other arrangements, whether it's price reduction or escrow arrangements.
And Mangaliso, if I can just maybe add, that hairy thing we call IFRIC 23 is also something to consider. So if you've done a due diligence on a target, you decide to actually acquire the target. Now that question comes up, do you disclose certain tax positions taken where there's an uncertainty of how it will be treated, whether SARS could challenge it, whether you should be raising provisions? I think all of those type of questions then come in after you've now acquired the target. So it's also just to be mindful of that.
Thanks, Crystal.
Thanks, Crystal and Mangaliso. So now I think we can move on to the funding and structuring. We did touch on this briefly in part one, and specifically the focus is on the debt funding versus preference share funding. So Christelle will take us through just on the structuring perspective, the purchase price allocation and also debt funding.
Thanks, Ntabeling. Yes, so assuming that we're looking at the purchase of assets, then the question always comes up about the allocation of the purchase price. Now, and I get this a lot and I must start with acquiring a business as a going concern is not one asset. It consists of multiple assets. So you're going to have to then look, and I've seen this many times where people also then continue to categorize assets. So they would categorize trading stock, they would say plant and machinery, and you actually have to sometimes go into the detail. You can't just allocate on a global level. Now, then the colleagues ask us internally, and clients often then ask me, okay, so if I'm doing a group rollover relief transaction, where we all are very aware that your base cost is rolled over and there's no CGT and all of that, do you still then need a purchase price allocation? And my answer there, it depends. I don't think it's straightforward, no, you don't, and always straightforward, yes, you do. Let me give you an example. If, for example, you're acquiring certain assets and some of those assets have high base cost than other assets, and you know that in the next few months you will be selling off some of the shares. So you're doing an asset for share transaction and you want to maybe sell some of the shares that you received as seller. Then you want to specifically allocate some of those higher base cost assets with specifically identifying them to certain shares so that you can apply the specific identification method when you sell those shares. That will give you an opportunity, as opposed to if you just did all the no purchase price allocation for a globular shares, then the question comes, and you want to sell some of those shares that you received as consideration, then the question comes, what's the base cost of that? Is it the aggregate? So I recommend that if you're buying a business, I think a purchase price allocation is good standard. The other thing to also consider while talking about Section 42 and asset for share transactions and purchase price allocations, what we also see is that people just assume that all the assets will comply, but you may have assets where the base cost is actually higher than the market value. Then Section 42 will not apply to that asset. So in those cases, 42 will not apply. It's worthwhile doing that exercise, going through the asset list and really testing those principles of Section 42. Then the question is, so if I've done a purchase price allocation in my agreement, does SARS accept that or do they challenge that? Now, SARS's stance on this is that they won't necessarily challenge these purchase price allocations. They will typically apply the purchase price allocation per the agreement, except I think in two circumstances. I think if we're dealing with connected persons, they may question whether they what the price was the purchase price allocation done correctly, etc. But the other way that they'll look at this is if there's any evidence that this is the purchase price allocation does not give effect to what the parties intended. So an example for it is that if the company is in a big assessed loss position and the entire purchase price for the business is allocated to the trading stock, I think that may raise some eyebrows with SARS, because they would say, well, you're not just buying the trading stock, you're potentially buying goodwill or other parts of the business. So yeah, so just be mindful of that. I think also talking about purchase price allocation and getting into the detail of the assets that you are selling is something that is often overlooked and picked up at a very late stage in the transaction. And we've actually seen SARS focus in certain M&A deals on this when it gets to disclosure in the tax returns, is the application of Section 22(8), where you sell trading stock that is not in the ordinary course of trade. So this doesn't often come up because I think generally people think not in ordinary course of trade is it's for individuals using assets for their personal benefit, or, you know, donating assets. This is what you're doing. But be mindful that selling all of your stock as part of a business as a going concern is not an ordinary course of your business. It's not. So you have to apply 22.8. SARS's interpretation note on section 22.8 does say that generally they do regard book value of trading stock as potentially the market value, because parties buying a purchaser buying all the stock at as part of a going concern for book values is potentially likely to be the market value in those circumstances. It's quite interesting that they refer to the transaction between the two and not look further to say, well, what would the market pay for those stock? But I think it's always just to be mindful of stock and just have a think about it when you're doing your purchase price allocation. Then just, I know there's a lot of clients online that may not be mining clients, but with mining, we've got the additional aspect of Section 37, effective valuation. So if you are selling a mine with mining capex and mining rights or land that there was mining on, you must be mindful that you need a DMRE effective valuation. And then there's in my view, a misconception that you're just going to apply the effective valuation, so you don't need a purchase price allocation in your agreement. I actually still prefer a purchase price allocation, because effective valuation only applies to the proportion of which you allocate between your mining assets and your property. So it doesn't talk about debtors, it doesn't talk about those type of things. So it's still worthwhile just doing the exercise. And then another very hairy topic that I think we can typically spend hours on and debate heavily, and the tax fraternity hasn't had a debate on this for quite a while, so I don't want to stir up things, but is this whole thing about assumption of liabilities. So we had the Ackermans case, and then SARS came out. They wanted to introduce some legislation around it, then they withdraw the legislation, and then they issued the interpretation notes. I think it's number 94. So this is I think what I'm just going to talk high level. I think what is often overlooked is that the assumption of liabilities from a seller's perspective will be included in your purchase price. So it's not just the cash amount or the amount allocated that you say for shares issued or anything. Be very mindful that your proceeds includes liabilities that the purchaser assumes. Okay. Then the question comes, but what type of liabilities do I have? You have to analyze them, because you get different types. You get contingent liabilities, which is dependent on an event happening. You get liabilities that SARS referred to as embedded liabilities. So those liabilities actually just reduce the market value of the asset you are buying. And then we get these valuation liabilities. And often and there could be a combination. A very good example is your doubtful debt provision. Your doubtful debt provision could consist of some valuation of doubtful debts, which is an accounting provision, or it could be actual credit notes that you foresee that you're going to be issued to certain clients. So you can see that there's a lot of the so-called devil is in the detail when you look at these things. The other thing as well that often comes up is, okay, so if the provision is then assumed, or the liability is assumed by the purchaser, who can get the deduction? And we've seen a lot of structuring around it. Some sellers would actually pay a cash price to the buyer to take over this liability, and then they would seek a deduction. I think what they're trying to do is do exactly what Ackermans, the judge, said in an obiter in passing, that maybe if they paid them to do it, they could get the deduction. There's a view that, well, you're actually paying through it by taking a lesser consideration for your assets. That's one view. And then the conservative one is that no, and you just apply what SARS is doing in the interpretation note. The purchaser as soon when they actually incur the liability, then they will see to what liability, where was that liability allocated to, go to that asset and then allocate that expense. So let me give you an example. If you allocate it to a motor vehicle, the assumed liability part of your purchase price, and you incur, let's say it's leave pay, then you can take the amount and then add it to the cost of your motor vehicle. That's in essence what SARS wants. I think what SARS is missing is how large these asset lists are, how complicated it can be. So I think if you're dealing with one motor vehicle, okay, but I think the type of transactions that we see, that's just practically not always viable. So a lot to consider when doing purchase price allocation, considering how I'm going to deal with my liabilities, and just to consider trading stock in general as well. Okay, so I think that is that on the purchase price side. I think next we wanted to just touch on the funding. So I think what's quite important is just to think about funding. If you're introducing funding to your structure, biggest question is, will I get a deduction for my interest? Be mindful of your interest deduction limitation rules, your 23 capital M, 23 capital N. If you're using rollover relief and your typical debt pushdowns transaction, your 23N will apply. If you're getting offshore funding, and this is also overlooked sometimes, is just to be mindful. It's very easy for us to identify that 23M will apply if you're getting funding from a connected offshore party, but it's any person that's not taxable in South Africa, and that could be a pension fund as well. So if you are getting funding through a private equity fund, potentially you could be caught by 23M without even knowing it. So I think it's just to be mindful. And I think where it becomes very complex is if you have an in-commandite partnership where you don't actually know who the limited partners are. So very complex again. Then if you are acquiring a target through a holdco, and you have back-to-back funding. I mean, there was a lot of noise about SARS withdrawing or wanting to withdraw Practice Note 31. They've backed down on that one. It seems like the final legislation would entail companies would be able to get it. So I'm not too concerned about that, but it's just something to keep your mind on. And then just talking about debt pushdowns and the structuring of it, the question always comes up. I mean, that was challenged by SARS, and they introduced the 23K at that point in time. Then 23K was an interim arrangement. They then replaced it with 23M and N, and then a lot of the guys and a lot of you may be aware of transactions that were actually challenged before 23K on debt pushdowns, where SARS, in most cases that we were involved in, reached settlement with the taxpayer to disallow quite a big portion of the tax, of the interest, saying that they applied guard. But I haven't seen the case that actually went to court myself, but it was all settled through settlement negotiations with SARS. Now, the question comes up, if we have 23N now that tells you exactly, if you do a typical debt pushdown structure, limit your interest accordingly, whether you could still be challenged by SARS. And I think the view in the market based on case law is that if you have an anti-avoidance section, which is 23N, then, and you fall into it and you apply it correctly, potentially you can't be subject to the general anti-avoidance rules. I think there's no definite answer on that. I think it's just always something to be mindful. And I think this is where the implementation comes in. It's important that you properly implement, make sure that the documents speak to the objective of the parties, the purpose of the parties, make sure that the main purpose is always commercially driven and not just tax driven. And that you also can't be seen to be misusing any legislation. So a mouthful, but I think it's quite important that you do just remember that. Always just look at your purpose, look at your implementation, make sure it complies. And then also, I think the other one is your subscription and buyback transactions. So we've got paragraph 43A, that's your specific anti-avoidance section dealing with subscription and buybacks. And unfortunately, we've been seeing some transactions being challenged by SARS that has progressed now through the appeal processes and all that. So we'll probably see that coming up of transactions pre 43A. So just be mindful of it. Also, just a little bit of a war story. Just be mindful when doing legitimate transactions where, for example, you're introducing BEE into a structure. Just go through the motions of paragraph 43A, even though it's not intended to catch that type of transaction. There are some cases where it could be caught. So just be very mindful of that. Okay, so I'm just checking. Okay, so just also from a practical implementation perspective, if we're doing a typical debt pushdown transaction, so where for those that you don't know, you incorporate a new co. NewCo gets the permanent funding and purchases the asset from the target so that you can liquidate the target company. You will get a full tax. You will get a tax deduction subject to the limitations in 23N on your interest incurred because you acquired it for productive purposes. Now, just be mindful, and we see that a lot where people don't consider complexities, for example, licenses. So the structure looks good on paper, but when implementation is due, then you discover that there's licenses that you can't move. Another big problem that we often pick up is immovable land. Then you realize that from some of the land, you have to get the Minister of Agriculture's permission, for example, or the consent. It takes so long that it just doesn't make it viable to transfer the land, or you'll have to have some rental or lease agreement while waiting for the consent from the agricultural minister. The other thing that we also see, and it's worthwhile doing the model, is that you can actually service the debt with this. If you have a sale and leaseback, for example, to cater for this land that you're waiting for to be transferred while you're getting consent, or licenses that you couldn't transfer, now you have a sale and a leaseback, for example. Those type of things are quite complex to just see that the companies can actually afford these things to service the debt, because otherwise you run into accounting issues from a going concern perspective. Yeah, so I think what's very important is when you do run these models to see how you can get the debt pushed down and all of that, just work in the tax assumptions, but with the commercials, and then make sure that you can properly address everything and be almost forewarned of complexities down the line with implementation, because these things seem to pop up while people are implementing and signing stuff and transferring at the deeds office. So, and unfortunately, then it's so late, and then you have to redo things, and then it becomes quite problematic from a paper trail perspective and all of that. Then I think also just on preference share funding, which is I think I've asked Ntabeleng if she can maybe just take us through Section 8E. Now, 8E, I think, has been settled, but now with the recent changes on 8E, and Ntabeleng, you've seen some action on that.
Yeah, quite a bit. So I think just before I go into 8EA, on what you were saying, Christelle, on the actual transfer of assets, etc., we've seen that a lot of taxpayers sometimes get caught with their pants down, especially when they use rollover relief and Section 44. So, you'll do your merger and you've met all the criteria and you've ticked everything and everything is nicely implemented. And then you have things like land and immovable properties there that need to be transferred. Now that needs to happen within 36 months, because then you must have taken steps to liquidate or deregister the amalgamated company. And then it's month 35. And then everybody goes, oh, well, we're still waiting on the transfer of all of these immovable properties. And then you run the risk of falling foul of 44. So suddenly what was a tax neutral transaction now attracts all sorts of nasty taxes. And then you should probably go to SARS and ask for an extension of the 36-month period, and et cetera, et cetera. But I find that in the planning of the transaction right up front, the parties don't keep in mind the 36-month deadline and forget about it until it's almost about to expire, and then that can cause all sorts of gnarly problems. So 8EA, there's been a lot of fun with 8EA. I think, you know, a lot of taxpayers have been quite actively trying to restructure their funding because of this proviso to subsection 3 that was introduced. And you'll know with 8EA subsection 3, it provides you a general carve-out or exception from the provisions of 8EA if first you use the preference share funding for a qualifying purpose, so buying equity shares in an operating company, etc. And then the security or an enforcement right is exercisable against a certain class of people, and that's usually like the issuer themselves or the operating company or someone in the same group of companies. So generally your security package will be your holding company will give security, the actual operating company or somebody else in the group. I think so everybody was quite comfortable that if you have your qualifying purpose, then you're fine. And it's at the time of getting the preference share funding where you go tick, and also getting your dividends, whether foreign dividend or your local dividend. Now this proviso provides that you must actually hold still directly or in, so it introduced an ownership requirement in respect of the operating entity. So before, where you could have a qualifying interest on day one and say, okay, well, I actually use this to buy the shares in the operating company, and now I've disposed of it, but I'm still carrying on because I still fall within 8EA subsection 3, that no longer applies because that proviso has suddenly kicked you out. So now this adds an extra requirement on taxpayers, because if you do use preference share funding to acquire the shares in your operating entity, you must always keep track of what you're doing with the shares in that operating entity. So if for some reason somebody comes along and offers you a lot of money to buy that operating company from you, say it's very profitable, you must still go back and think about that preference share funding that you utilize to buy those shares. And obviously you'll fall out of it if you use the disposal proceeds from that you receive from disposing of those equity shares to redeem your preference share funding. But that means then you'll have to kind of renew your preference share funding or get a new pref share facility or something if you do want to sell the shares in your operating company. So this could actually introduce quite a big administrative burden on you, and I think it limits the flexibility of taxpayers. So before you dispose of the shares in that operating entity, you don't just think of the commercials of that, but you must think about the funding that you utilize to actually buy the shares in that operating entity. And then, so the section says if you used it directly or indirectly to buy shares in an operating company. And now, so in the commentary, the example for indirectly is like if, say, a holdco wants to buy shares in an operating company, and you've got your subsidiary, and holdco goes and procures the preference share funding and advances it to its subsidiary as an interest-bearing loan, for instance, and they go on and buy the shares. So that would still be indirect acquisition of shares in an operating company. So you still fall into the qualifying purpose, but now you've got an extra complexity, because not only must you keep 8EA in mind, but you must now also think about the deductibility of the interest in the subsidiary that's now taken on this interest-bearing debt. And like you say, the economics of, well, when the subsidiary now services that interest, and they have a limitation on how much interest they can deduct, then how much of the dividend can you actually flow through ultimately to service your preference share dividends, etc., etc. And also you might be creating dry tax at the holdco level, because they receive interest income and they pay out dividends to service the preference share funding, but they will not be entitled to a deduction there. So you'll just have an income tax at 27% of your interest, but no corresponding deduction there. And, you know, obviously because you don't have any deductible interest expense, 31, practice note 31 won't come to your aid there. So I think it's very important to do the modeling upfront when you are structuring, whether you're going to do a direct acquisition or use a subsidiary, and how you're going to fund these various legs of your transaction, and do the modeling to see where there might be tax leakages, right? So whether it's interest limitation rules or Section 80A, and if one day you dispose of that, you also need to think about what the impact on you would be. So would the tax actually make your commercial decisions for you? So would you take the decision based on tax and say, well, I'm not going to take this wonderful opportunity because suddenly 80A3 will catch me? Or do you rather want to take that leakage and absorb the loss? So I think the financial modeling right up front when you are doing your structuring is critical. And I think this, the people don't walk through the different iterations of what could happen and how much risk they are willing to actually take on. And of course, this is never the funder's problem, because there's always very nice gross up clauses in the pref share terms that say, if suddenly you don't have a qualifying purpose or you don't fall into 8EA3, then you will pay the funder the net of what would have been payable if 8EA3 had been applicable to you. So I think, with the pref share funding, taxpayers just need to think long term as well about where they want to be, whether they intend to keep the shares in the operating company until such time as they've paid off the preference share funding. And if you do want to dispose of the operating entity, will you be able to generate enough to settle your pref facility all in one go, or what would happen there? So I think that the modeling is very, very important there. And then just one thing, sorry, Crystal, on the last point is exchange control. Now, so I've seen a lot of transactions where, everything is designed very nicely and, everything is put in place very nicely. And then we go back and we say, okay, well, there's a non-SA party involved in this transaction, and they will have to either sell the shares or something's going to have to happen. And then there are no historical approvals in place. So you'll find that you have to go with your begging bowl to the SARB and ask for condonation of historical things that have not been properly approved. We have gotten a few condemnations from the SARB recently, but they did release kind of like a statement, and this was about 2 years ago, where they said they are re-looking at the condemnation of non-compliance with the regulations. They are trying to tighten controls and get people to, or encourage people to comply with the exchange control regulations. So it has been a bit more difficult. Our experience was before, you just ask for condonation and you put forward a very good explanation. And if you weren't mallified in any way, then you would likely get your condonation. But just when you start your structuring, you have to make sure that all your exchange control approvals are in place that were required historically. And if not, your first step should probably be to go and try to regularize your affairs with the SARB.
And just to add to that, Ntabeleng, is also what we see is that non-resident investors are sometimes not aware or not familiar with our exchange control provisions. And it can be frustrating for them, and it needs to be taken into account when doing the structuring, especially where there is IP in the target, and also to make them aware of possible loop structures, because what we've seen is that non-resident investors will invest in a South African entity, and then down the line they want to restructure their IP, and then they are made aware of exchange control for the first time, which can be really frustrating for them. So it's really important to take that into account during the structuring process as well.
Agreed. So just, Crystal, if there's nothing else on funding and structuring, if I can move on to the transaction documents, another problem. And I see this particularly when we use rollover relief in internal restructures prior to the implementation of a broader sort of third-party transaction, is the sequencing of the transaction. So, you know, your tax advisor will review your transaction documents and everything looks nice and you've ticked all of the boxes. And let's say, for instance, you have an asset for share followed by some other transaction and then bundling in this example. So then you'll get your resolutions and all your agreements, and then the board will then sign all the resolutions on the same day. So essentially the transaction has been, all the transactions have been effected in their sequence on the same day. However, for Section 42 to apply, the person who disposes of their asset to the company must hold a qualifying interest in the company as at the close of the day of that transaction. So you must have implement your asset for share transaction on day 1 and the balance of the transaction on day 2 to ensure that you have a qualifying interest on the close of that day. And then nobody picks this up because now you've done all of your transactions in one date and suddenly your asset for share transaction is not compliant with Section 42 and you don't qualify for that rollover relief. So it's little things like that, you know, and like your corporate hygiene, the sequencing of your resolutions and the signing of your resolutions. You know, you'll try your best. Usually you'll say if there's a few steps in a transaction, then you'll put in the agreement that this step is interconditional on, you know, is conditional on the implementation of step 1, 2, 3, whatever. However, you just do need to get your timing right and make sure that you're not inadvertently tripping yourself up with complying with the requirements of different sections, and just keep the timing in mind as well. And also, you know, when you have things like asset for share transactions or some kind of transaction like that, and it's for the issue of one share, we'll find things like we come back 6 months later and nobody has issued the share. So the resolutions are nice, are signed, the transaction documents are good, everything is fine, but it hasn't actually been carried out from a corporate perspective where it hasn't been done. And I think it's very easy to overlook the issuing of one share, for instance, right? Or getting the number of shares that are issued, right? So you still need your tax advisor to be there to see that your implementation is correct and that you're not inadvertently tripping yourself up by, you know, contravening any of those kinds of timing provisions. Christelle, I don't know if you want to add anything on that.
Yeah, just a war story on the one share. We had a transaction where meticulously we got opinion on the one share. Everything was done perfectly. And then 6 months later, we realized that there was a dividend and they didn't declare a dividend on the one share. So then the question starts popping up, but did you really intend to issue one share if you're not even giving that one share its 1% of the dividend? So it's small little ridiculous things like that could trip you up, and those are the things that SARS spoke at. Let's another example, and I wanted to quickly talk about your financial disclosure. So we often excited, we got the deal going, we got the tax, we got the opinions, everything is marked right. But then nobody looks at how the accountants will interpret the transaction and certain legs of the transaction for financial disclosure. And SARS have recently picked up on this. So I think everybody must appreciate that 90% of the people at SARS is accountants and has an accounting background. So they will look at financials as a first step. So for example, share subscriptions and buybacks, then they would ask a simple question: reflect where in the financials was the dividend that you received on your share buyback. If you say it's a dividend, you say it's exempt income, show us where's the dividend. And then you start looking at it, and maybe the accountants didn't recognize it as a dividend, but they recognize it as something different. So I think in transactions, in very large transactions, where I think that was a very where all the parties work around a table, is where you draw in your accountants or your technical accountants in your team. Start thinking about the accounting paper. For example, if you So we've seen so many examples where we start talking to the technical accounting guys and they're going to completely reflect it differently. Then it's fine, because accounting and tax can differ. But then as long as you're mindful of it and you manage it, for example, in the disclosure of your financial statements, so that you can get the sort of the tax result that follows the legal and follows the tax law, but maybe have been disclosed differently from an accounting perspective. So I think I always like pre-warned and know what I'm facing and know how I can deal with it, as opposed to being asked by SARS and then not having a good answer at that point in time, and then maybe appear to have not thought about it. So I think that's quite important. So let's just be mindful on your financial treatment or your accounting treatment of transactions.
Absolutely. We're almost out of time. So I think just in closing, the important thing here is to keep your tax advisor, your accountants, and your corporate advisors on the same page at all times, that everybody knows what's happening, so that nothing falls through the cracks there. And if there is some a kind of divergence between accounting and tax, for instance, that you put it in a tax opinion or record it somewhere and say why that is, so you're not caught with your pants down. So thanks, everybody. We see your questions in the Q&A, and we will attempt to get back to you on just an individual basis, just because we are out of time. But that's it from me. Christelle, Mangaliso, I don't know if you have anything else that you'd like to raise?
Nothing from my side. Thanks. I think we needed hours to talk about this topic, and maybe around a table and debating these things. But it's always just enjoyable to share some war stories and things that we pick up and we see recently. So I hope this was informative, and I mean, we seek feedback. So if anybody has any feedback or want to have like another series of this and zoom into some things, I mean, please let us know.
Nothing from my side, Nsabaleng, but just to add that we did sort of rush through some of the points because of time. But if there is a specific point that you would like us to engage with you on a bit more details, please feel free to reach out, and we're happy to engage. Thank you.
Thank you, everybody. Have a good day.
Thank you. Bye.